Welcome to this deep dive, which today we're calling Cash Flow Lab. Our mission really is to tackle this puzzle, the stock market. It just keeps hitting records, right? Even when all the old warning signs are flashing red. So we're going to dig into the sources, try to figure out what's really going on, look at some, well, frankly, hidden risks in those high prices, and map out the huge role government and central banks are playing. It seems deliberate.
It really does. And it's crucial because if you've been watching this, maybe feeling that something's off, like unnatural even, you're onto something fundamental. It feels like gravity's just been switched off for the markets. We need to unpack the forces, these big systemic things that are pushing everything up, and why the big institutions aren't reacting like they usually do.
Okay, let's start right there with how disconnected things seem. If the market's defying history, we need the numbers. What's the big picture sign that things might be fragile?
Well, a really good place to start is the metric favored by, serious long-term investors, the Buffett indicator. It's pretty simple, actually. It just compares the total value of all U.S. stocks, the market cap, to the size of the whole U.S. economy, the GDP. Its strength is its simplicity and, well, its track record.
Okay, so give us the current numbers. What are we looking at right now?
Right. So the total U.S. stock market cap is bouncing around $66 trillion, give or take. And the U.S. GDP, that's roughly $30 trillion. Now, historically, a ratio of 100% where they match, that's seen as fair value. Stable.
Yeah.
Anything way over that, that's
Yeah.
danger zone territory.
66 divided by 30. So the ratio is, wow, okay, it's soaring above 216%. That sounds massive. How does that stack up historically?
Oh, it's historic, all right. I mean, think back to the dot-com bubble, late 90s, absolute frenzy. At the very peak, 1999, just before it all came crashing down, that ratio hit 115%.
Only 115%, and we're over 216% now.
Exactly. Not 150, not the 180, over 200%. So if you just looked at that one metric, which has a pretty good history, the conclusion is kind of stark. The market looks deeply, deeply overvalued.
That's the big picture. But you see it down at the company level too, right? If you look at the giants, the big S&P 500 stocks, let's talk price-earnings ratios, the PE.
Yeah, and the numbers there are, pretty startling too. The current average PE for those big companies driving the index, it's sitting around 66.
66. Okay, context. A normal, healthy company might be 15, 20. Maybe high-growth tech hits 25, 30.
Right. That's the range.
So people argue, okay, maybe this time it's different. AI, future tech, massive growth coming. Doesn't that justify a high PE? Why is 66 definitely, absurd?
That's the key question, and why 66 is such a flag. A PE of 66 means you, the investor, are paying $66 today for every single dollar that company earns in a year right now. To make that $66 make sense, economically, you need decades of just unbelievable, almost vertical earnings growth. It assumes this massive, immediate explosion in profits.
Which seems unlikely for companies that are already huge, mature businesses.
It's fantastical, really.
Mm-hmm.
The historical precedent just isn't there for that kind of sustained growth from this level. It strongly suggests something else is pushing up the price, something beyond just, organic company value.
Okay, so that's the pivot. If the smart money sees these strained valuations, why aren't the big institutions selling off? Why haven't we seen that classic cycle? Euphoria, smart money gets out, some catalyst hits, then boom.
Yeah. The fact that they're largely still in suggests there's this powerful outside force, something constantly pumping air into the balloon, creating demand no matter the price. And that force, it looks a lot like massive government spending.
Okay, we know the government's huge, biggest spender, collects around $5 trillion in taxes.
Yeah.
That money flows back through Social Security, Medicare, defense contracts, right? So it supports corporate revenue.
Sure, that's the baseline. But the really critical factor now is the overspending. The government isn't just spending tax money. It's spending at least $2 trillion more each year than it takes in.
$2 trillion extra every year. That's massive deficit spending. Unprecedented, really.
Colossal is the word. And that $2 trillion, it has to be borrowed.
Right. Borrowed money, created out of thin air, basically, and then injected straight into the economy.
Straight in. Transfer payments, maybe infrastructure, defense. It goes to people and companies. And where does it end up? Sooner or later, it lands in the revenues, the profit margins, of those big corporations whose stocks drive the market indices.
Ah, okay. So it creates this artificial boost, a huge fiscal tailwind, you called it.
Exactly. The market isn't just flying on pure corporate genius right now. It's getting a massive, constant push from borrowed government money. That helps inflate the earnings numbers, which makes those crazy PE ratios look, well, Slightly less crazy for a moment.
Okay, but spending $2 trillion extra a year, that can't be an accident. It feels like a conscious decision. So why? Why would the U.S. government choose to pile up debt like this, ignoring all the old rules about balanced budgets?
Well, this is where you have to zoom out, look at the bigger picture. The global context. The world order is changing, right? Since World War II, basically it's been the U.S. on top,
Yeah.
financially, militarily. A unipolar world, they call it.
But now you've got China rising, India, other blocs forming. It's becoming multipolar, more complex, more competitive.
Exactly. And the sources we looked at suggest this incredible deficit spending is actually part of a high-stakes strategic gamble by U.S. leadership. The number one priority, it seems, is to maintain that global leadership position, to compete, to outspend, out-innovate rivals, at least until this new world order settles down.
So the thinking is, spend whatever it takes on defense, tech, keeping things stable at home to stay ahead.
That seems to be the calculation. Spend astronomical sums now, worry about the debt later, or maybe manage the debt in other ways.
So staying dominant is job one, more important than the debt itself in this view. And that geopolitical goal is driving the spending that fuels the market.
It appears so. The debt becomes sort of a secondary concern compared to the immediate strategic imperative. That's the ultimate why behind the fiscal engine pushing stocks up.
Okay, so if the strategy involves spending trillions you don't have, there's a necessary consequence, right? Something the system has to accept, maybe even rely on.
Absolutely. And that consequence is currency devaluation, which we mostly experience as, inflation, persistent inflation.
And that's the hidden bet. The sophisticated investors, they're not just betting on companies doing well.
Not entirely. They're making a fundamental bet that the dollar itself will continue to steadily, predictably lose value. Its purchasing power will go down over time. And this isn't accidental, it's sort of baked into the strategy.
Explain that bit. How does a weaker dollar actually prop up stock prices? It seems counterintuitive.
Well, think about assets priced in dollars, stocks, real estate, commodities. If the dollar itself gets weaker, the nominal price of those assets has to go up just to keep pace. Right? So a company might raise its prices. Its profits might go from, say, $10 million to $20 million. That looks great on paper.
Even if they didn't sell more stuff or become more efficient, just because the dollars are worth less.
Exactly. It's an illusion of growth, in a way. But it allows companies to report higher nominal earnings. And that illusion, that devaluation effect, is the quiet engine constantly helping to support those inflated stock prices.
Okay, but for the government to borrow trillions year after year, they need someone to make it easy to keep borrowing costs low. That's the Federal Reserve's job, the monetary side.
That's the Fed's role. The enabler, you could say. They have to ensure there's enough money sloshing around, enough liquidity, and that the government can borrow cheaply. The main tool they use is quantitative easing, QE. Heard a lot about that.
Right. Creating new money digitally.
Basically, yeah. They create digital dollars and use them to buy assets, mostly government bonds, from the big commercial banks.
And that does two things. Keeps demand high for government debt, so interest rates stay low for the Treasury.
Check. Keeps borrowing cheap for Uncle Sam.
And it also pumps trillions of new liquidity directly into the banking system.
Exactly. And what happens with all that liquidity, especially when interest rates are deliberately kept super low?
Well, it punishes savers, right?
Right.
Holding cash means you're actively losing purchasing power because of that devaluation, that inflation.
Precisely. It creates what they call TE. There is no alternative.
Ah, TE. So cash loses value, bonds pay almost nothing.
So where does the money go?
Yeah.
It's forced out onto the risk spectrum, towards things that might keep pace with or beat inflation.
Like stocks or real estate.
You got it. It's like aiming a fire hose of newly created money directly at Wall Street. It creates this constant underlying bid for stocks, helping sustain those prices, even when the fundamentals, the valuations, look crazy.
Which brings us to the cost. This whole setup, this manufactured market stability, it feels like it's built on shaky ground. And it seems to have a really corrosive side effect. Wealth inequality.
Yeah, that's a major consequence. You have to look at who actually owns the assets. In the U.S., the top 10% of the population owns the vast, vast majority of stocks and financial assets.
So when the market goes up, even if it's just that illusion of growth from devaluation, the wealth of that top 10% balloons?
Right. Their assets effectively act as a hedge against inflation. In fact, inflation can be a benefit for them because their asset values rise faster than the dollar loses value. They get richer on paper and often in real terms, too.
But for the other 90%, the majority of people.
It's the opposite story. They mostly live on wages. And wages, as we all know, rarely keep up with the real cost increase for essentials: rent, food, healthcare, energy.
So they get squeezed. While the stock market hits records fueled by debt and devaluation, the gap between the asset owners and everyone else just gets wider and wider.
It actively exacerbates the wealth gap.
Mm.
The very mechanism keeping the market afloat disproportionately benefits those who already have assets,
Mm.
often funded indirectly by the government borrowing.
Okay, so given this situation that the foundation seems artificial, this can't go on forever, what are the really sharp investors doing? The so-called smart money. Are they playing along?
Well, the sources suggest they are being extremely cautious. You look at someone like Warren Buffett, his company, Berkshire Hathaway, sitting on a record pile of cash right now. Just huge amounts.
They're not chasing this market higher.
No, they're holding back. They aren't deploying all that capital into a market they likely see as euphoric, disconnected, and fundamentally propped up by debt and this devaluation dynamic.
So they're positioning themselves for what? The end of the party?
Pretty much. They understand that cycles always eventually turn, that fundamentals do matter in the long run. They seem to be preparing for the correction.
The inevitable correction. Maybe a crash.
Could be swift, could be brutal when it comes. And they want to be ready, with cash, to step in and buy valuable assets when they go on sale at a massive discount. They're patient because they think they understand how the current game is being played and that it's not sustainable. Hashtag listener takeaway and outro.
So wrapping this up, if you're listening, the big takeaway here is really understanding what's underneath the headlines. The current market strength isn't just about amazing companies. It's heavily influenced, maybe even driven, by deliberate government overspending and the currency devaluation that comes with it.
Right. It's not necessarily a sign of pure organic economic health. And knowing that, well, it means you probably can't afford to just sit on the sidelines passively.
Yeah.
If your plan is just holding cash, hoping for the best, in this environment with planned devaluation, you're essentially choosing to let your savings erode silently over time.
Doing nothing is a choice to lose ground.
Functionally, yes. In this specific financial world we're in, you have to make informed choices just to try and preserve your purchasing power.
So the real question isn't if this gap between sky-high prices and underlying value will eventually close. It's more about when reality bites back.
Exactly. And those who actually grasp the mechanics, who understand why the market rose like this, the role of strategy, debt, and devaluation, they'll be the ones best positioned to navigate whatever comes next.
Okay, that's our deep dive for today here on Cashflow Lab. Really appreciate you joining us to explore the hidden forces shaping the financial world. Do follow the show for more insights like this. We'll be back next time digging into another aspect of the economy and your money. Thanks for listening.